Wes, Austin, it's good to see you both. I'm glad you're here because we have a lot to dive into today. We are talking about the Silicon Valley Bank and the markets. Of course, it is Tuesday as we're recording, but I know you wanted to be proactive in communicating with your clients because people are feeling a little bit anxious. So, of course, the Fed has been busy moving to stem a U.S. banking crisis. So, let's start with what's most important to your clients. Wes, what do they need to know?
Well, first and foremost, Aaron, most important thing is that clients and their investment accounts are safe and they are not subject to the same issues that we saw with a regional bank this past weekend. It's important to note that an investment account is a lot different than a bank account. So when we deposit money at a bank, that becomes a liability of that bank. Banks can lend out based on deposits. They work on what's called the fractional reserve banking system, and it's much different with an investment account. So being held at a large institution like Fidelity, client accounts are segregated and they are not a liability of Fidelity. So therefore, it's totally different, but it's very understandable to have that question of, wait a second, if my money at the bank isn't necessarily safe like those that had money there. Of course, the FDIC came in and saved that, but it's a very valid concern to have that question, but rest assured, it's a very different thing.
Right. Which is why it's so important to talk it through because this is a complicated situation, which is why I'm so glad you made time to talk to me today to talk this through. But like you're mentioning, Austin, Wes just talked about the FDIC insurance, which will guarantee up to $250,000 in the bank. So what if I do have more than 250 in the bank? Should I be concerned?
That is a valid question, Aaron. And no, you really should not. I think it's a good time to take a look that if you do have 250,000 at one institution, now's a good time to certainly take a look and spread that risk across a different institution so you can be sure that you're under that limit in which it is insured. I don't think it's time to hit the panic button by any means, but certainly we want to evaluate our position across our cash accounts and be sure that we are just under that $250,000 threshold.
Okay. So the next question, Austin, again, I think a lot of people are trying to draw parallels or at least understand how this compares to the 2008 banking financial crisis. Do you see any similarities?
Yeah, and I think that's a natural correlation or question and concern there. But really, I do not think it is anything like 2008. So one place to start and a big distinction is we have globally systemic important institutions, and those banks are the big banks that we're familiar with, right? Our JP Morgans, our Citigroups, our Wells Fargo. And those corporations certainly have a more diverse balance sheet than Silicon Valley Bank, where Silicon Valley Bank was really focused on the venture capital space. And they really made a big mistake there in buying a lot of US Treasury bonds, specifically long-term bonds, which we know as rates rise, which they did dramatically over the last 12 months, those securities decline in value. And really their big trouble came when investors demanded their cash back and they had to sell those positions that were at a substantial loss to meet cash demands.
Right.
Whereas, the big banks, certainly, again, as I mentioned, have a more diverse balance sheet, did not have those same cash requirements.
Right. No, I think this is all just going to come down to mismanagement. It is kind of a head scratcher when, I talk to experts like you, and it's just confusing to understand how they were investing money. But, Wes, I think that a lot of people are wondering, okay, clearly a lot of moving parts, like we mentioned, we expect some changes. What are you looking for next?
Well, certainly we think that until the dust settles, volatility is going to be there in both the equity and the bond markets. And the bond market is actually telling us something kind of interesting right now. We saw a really quick move just the other day in short-term bonds dropping their yields from about 5% to 4%. Mm-hmm. And when we have yields go down, bond values go up. So essentially what the bond market is saying is they don't really think the Fed is going to continue on the same rate hike expectation that we had before. Likely that will probably slow or maybe even pause. We'll have to see. But certainly volatility is here to stay for the near term. And we'll just have to see how things settle out. But we are paying very close attention to that sort of thing. And given that yields are coming down, there's actually some opportunity for capital appreciation in bonds at this time.
Right. Okay. Well, Again, thank you both for making time today on what is a very busy day for you. But if somebody is feeling anxious or has more questions about their investments or just wants to talk through these headlines, what's the best way to reach you?
Simply reach out to us via phone, 919-322-4113, and we're always available by email as well. info@patriotwealthnc.com.
Okay, Wes, Austin, thank you both very much.
Thank you.
Thank you.